Hello YouTubers, Alaska Prepper here. This is your wake-up call for Thursday, October 25th, I believe. Let me check. Is it October 25th? Yes, it is. So I'm sure you've all been hearing the news, and there's probably a whole bunch of other channels that are talking about how the stock market is not doing very well. Supposedly, it's erased all of its gains for 2018 as of yesterday, the 24th of October, with its 600 plus point drop. And I wanted to go over a little bit of the history of the stock market. I came across this article that was written yesterday, so I'm going to go over this article. It's really quick, so this won't be a very long chat. And I also wanted to show you a couple of other things that I think have something to play in all of this. Okay. Well, look at this too. Look at this picture. Okay, so anyways, the title of this article is "This Day in Market History: Stocks Begin Crash with Black Thursday," and that was back in October 24th, I believe, of 29. But I'm sure the article will say it. But take a look at this picture. All right, this was Black Thursday. Look at this bank advertisement. American Union Bank, 4% paid on thrift accounts. So these banks were paying 4% interest on what I'm assuming was like a savings account. How much interest is your bank paying you today? I just saw that there. It's not part of the article. Okay, so it says here, each day, Benzinga takes a look back at a notable market-related moment that happened on this date. What happened on October 24th, 1929? The Dow Jones plunged 11% to kick off the first U.S. stock market crash. Where was the market? The S&P was slipping from 27.99 at the start of October to 2058 to a 2058 monthly close. The Dow was on its way down from 39.91 to 34.86. What else was going on in the world? The world population was 2 billion. Life expectancy was 55.8 years for men and 58.7 years for women in the US, that is. Black Thursday takes down the markets. Following the September crash of the London Stock Exchange, the Wall Street crash of 1929 began with the Black Thursday tumble. And this is something, ladies and gentlemen, that I think will be an indicator for us. I think, and I've said it before, I think that the US dollar / economy / whatever you want to call it is the cleanest dirty shirt in the hamper. So I think that before we see real crashes and things like that happen here, we will see it happen in other countries. I think starting with emerging economies, they will start tumbling, which they already are. A whole bunch of emerging economies are stumbling, and there's other countries also in the West that are stumbling pretty badly as well. All right, look at Argentina. Look at, well, I'm not sure if Argentina is considered an emerging economy. I don't think it is. But look at Italy. I believe Spain is having troubles. Germany, the EU, pretty much every Western country is having troubles, and emerging economies are having troubles as well, especially with the rising of the value of the dollar. Okay, so let's continue. A record of 12,894,000 shares exchanged hands. The ticker tape fell 4 hours behind, and bankers attempted to calm the storm with significant block trades. A few days later, on what is now known as Black Tuesday, the New York Stock Exchange lost billions of dollars on a trading volume of 16 million shares. These sessions marked the start of the Great Depression, which plagued Western nations for the next decade. The events followed a period of rapid expansion in the U.S. market, which itself succeeded a term of great speculation. A number of poor circumstances befell the nation. Production and wages fell, unemployment surged, debt and bank loans proliferated, and agriculture stumbled. I guess you can say that's called stagnation. Alright, so this is what was going on around this time back in 1929. Okay, and I wanted to go ahead and go over another quick article with you all that I think is pretty significant. Okay, and I'll leave the links to these articles so you all can take a look at them if you like. And this is what I think is significant. This is one of the reasons why I think that our market is fake. We have a fake market that has no fundamentals whatsoever. Okay, so if you do fundamental analysis on a company, what makes the value of a company go up and down so quickly? Okay, so let's say that a company lost 10% of its value from one day to the other. What does that mean? What made the value of that company, the actual value of that company, go up or go down so quickly just in one day? Well, this is why I think that these valuations go up and down so quickly. Because think about it. If you have a company that makes a widget and that company owns a building, hires 100 people, and makes 1,000 widgets a week, okay, and that company is worth X number of dollars, all right, it's valued at X number of dollars because of what it actually owns and what it produces. Why is it that in one day that company can lose 10% of its value? It still has a building, it still produces X number of widgets, it still has employees. The employees that were there yesterday are still there today. Okay, all of the fundamentals are still there. Okay, now what is it that makes it lose so much value just in one day? And this is what I think it is. Now, understanding, ladies and gentlemen, that I'm not an expert at this, but it's just looking at how can a computer determine what the value of a company is, i.e. a stock. Okay, so let's go on here. Well, let me read the has automated trading hijacked the stock market? And it goes on. It has been comical to watch the parade of guests on the business news channels this week try to explain to viewers and to one another why our hyper-efficient financial markets, the ones that are supposed to be so brilliant at pricing the value of everything, have been bouncing around like a squash ball on an overheated court. Pay no attention to the volatility. These financial wizards assure us it's just a little technical correction, a bit of froth being taken off the top of a market that had gotten a bit ahead of itself. The fundamentals of our otherwise sound economy will soon reassert themselves. Why is it that when the market is climbing by improbable leaps and bounds month after month, that we are supposed to take that as a genuine reflection of the fundamentals? See, that's what I was talking about, ladies and gentlemen. The markets are just jumping, going up and up and up and up and up and up. What's making these companies value so much more day after day after day? What are they doing? If you can investigate and say, well, this is why they're jumping up and up and up. Let's say I'm investing in a gold mining company, all right? And this company discovers a huge amount of gold one day, and their stock just rockets up. That makes sense. The fundamentals behind that move makes sense. But why is it that a company, what if that company just kept going up and up and up and up in value after only making one discovery? Where are the fundamentals that support the value of that company rising even though nothing new has happened to make that company's value worth more? That's what they're getting at right here. Let's see. Okay, but when the market is in free fall, we are supposed to write that off as monetary fits or irrationality. The truth is that the market is just as irrational and divorced from fundamentals on the way up as it is on the way down. It is in the nature of markets, more so today than ever, thanks to the computerized high-frequency trading strategies of the Wall Street wise guys. What we've watched this week is herd behavior on steroids. And it is herd behavior, but not by people, mainly by computers. And this here shows you a little bit of where we're at and what's going on with the market. That's a pretty substantial drop. That's almost 10%, I would say. So almost taking a 10% drop. Okay, let's carry on here. It is important to remember that a small fraction of trades on the stock market these days, maybe 10%, are made by real life human beings deciding to buy or sell shares in this or that company. Another 40% or so reflect decisions to invest in the entire stock market or an entire industry or an entire class of companies, index funds, exchange traded funds, ETFs, or other kinds of passive instruments. That leaves half the trading that is done automatically by computers, according to complex algorithms that focus on changes in the market, in market prices, or in indices caused by the trading done by other computers. In this kind of robot versus robot trading with its circular logic, fundamentals are irrelevant. The volumes are enormous, and the holding periods are often a matter of minutes or even seconds. More often than not, a trade is likely to be a combination of trades, buying this stock, shorting that ETF, while selling a call option on some derivative instrument, and almost all of it is done with borrowed money. Okay, I'm going to leave it off right there, ladies and gentlemen. If you guys want to continue to read this article, I will leave the links on there. But I'll just try to make a point that what you see in the stock market is not real, in my opinion. In my opinion, the stock market is just as real as the zeros and ones that you see on your computer when you're looking at your bank statement. It's just as real as the numbers that you see on print in the statement that you receive from your 401k or your CDs, all right, or your pensions or your investment instrument. It's just as real as those are, which is not real at all. Okay, because you have a whole bunch of computers deciding what the value of something is going to be without ever having looked at that actual company or property or investment type, without actually ever having looked at it. It's a computer saying, okay, so you're selling, so I'm buying, you're selling at this price, and it's all algorithms that are programmed to these computers. How can that be real? That's my question. How can that be real? It's not. It's not real. All right? When you look at the fundamentals and you decide to invest on something, that's real. And only about 10% of the stock market, as I read here, is based on actual live human beings making a decision to trade in or out. Okay, so I'm not going to beat that horse to death. All right, I hope you guys come and take a look at these articles and decide for yourself. Okay, so and I just wanted to take a look at this. Now, this is the chart of the Dow going back to, I believe, around 2009 roughly. All right, and this is ending yesterday. As you can see, yesterday there was a 600-point drop. Okay, so just take a look at this, ladies and gentlemen. From the beginning of what is so-called the what do you call it? After the Great Recession, you know, we started doing better and better. I'm at a loss for words. Words don't come easily to me unless I have them in my mind already. Okay, So as you can see, right after the Great Recession around 2009, goes back all the way back to March of 2009, which was right at the beginning of what was supposed to be us doing better or getting better. So you can see how much we've gone up. We started at, let's say, at 8,000. Since 2009, our Dow has gone up more than 200%. We started at 8,000 and we are at 24,000. So we are more than 200% higher than what we started out just shy of 10 years ago. And my question is this: what makes those companies more valuable? What's making those companies more valuable is that the interest rates were so low for so long that large corporations found it more profitable to borrow money at low interest rates to purchase back their own stock. All right? Therefore, manipulating the stock price to the upside. Because when more stocks of something is purchased, all right, the less available stocks there are in the market to be bought, which makes the price of those stocks more expensive. Okay? That's what's going on. And now that interest rates are going up, large corporations are not doing this as much. And I know I've said this before, I'll say it again. If you go and listen to Ms. Lynette Zhang at ITM Trading, she has documented that the big players, so-called the smart money, are getting out of the stock market in large numbers. They are getting out. Why are they getting out? Why? Because someone has to be left holding the bag. And you know who that someone is, ladies and gentlemen? It's not going to be the smart money. It's not going to be the CEOs and the big wigs from these large corporations. They're not going to get caught holding the bag. The average person in the street that invests in the stock market, the average person in the street that has a pension, those people are going to be left holding the bag. Okay? I think I remember reading an article here a while back, and I didn't go over this, that CalPERS, which is California's largest public pension fund, that they invest a ton of their money, or a ton of their trust fund, you know, the pension trust fund in CalPERS, then they invest a ton of it in the stock market. Ladies and gentlemen, what's going to happen to those pension funds when the stock market goes down by 50%? How are they going to pay their pensioners or their pensioners? All right, how are they going to pay them if they're not going to have the money? So those of you that have pensions, and like myself, I have pension, all right? And as far as I'm concerned, when this balloon pops, government pensioners are going to be just as hurt as regular pensioners, okay? So when this balloon pops, ladies and gentlemen, only because you're not vested in the stock market doesn't mean that you will not be affected. Because if you're a pensioner, more than likely you are vested in the stock market, whether you think so or not. If you have an IRA, more than likely the plan that you fall under has investments in the stock market. We are all going to be affected in one way or another when this stock market goes to its fair value. Okay, so that's going to be it for today, ladies and gentlemen. I did have a quote that I wanted to share with you all because it is very telling. And this quote is by a person who's called the father of Keynesian economics. If you don't know what Keynesian economics is, look it up. It is the opposite of somebody help me out here. Man, you know what? I am terrible. My memory is terrible. Anyways, Keynesian economics, and I know one of you guys are going to go ahead and put it in the comments and go ahead and put it on there so that the rest of the viewers can see it. Austrian, hot doggity. Keynesian economics is pretty much the opposite of Austrian economics. And Keynesian economics, really quick, I know it's a lot more in depth than what I'm going to tell you right now, but in Keynesian economics, Keynesians feel that you can print money forever and just keep printing money and keep printing money, and it's going to solve everything. Okay, Austrian economics, one of the fundamentals of Austrian economics is you spend what you have and don't spend anymore. Okay, so anyway, this guy here, the father of Keynesian economics, John Maynard Keynes, this is his quote: by a continuing process of inflation, which means money printing, government can confiscate secretly and unobserved an important part of the wealth of their citizens. All right, ladies and gentlemen, so go ahead and read that and let that sink in. I'll read it one more time. By a continuing process of inflation, government can confiscate secretly and unobserved, keywords, secretly and unobserved, an important part of the wealth of their citizens. Having said that, ladies and gentlemen, I hope you have a good day today. Okay, remember that this Saturday at 10 a.m. Alaska time, okay, this Saturday at 10 a.m. Alaska time, I am going to attempt to premiere the Twilight Zone at 10 a.m. Alaska time this Saturday, okay, to see if I will be able to do some live chatting with those of you that are able to join the chat. So please find out what 10 a.m. Alaska time is for where you're at, and if you're able to join in, I think it'll be a lot of fun to do a little bit of live chatting with you guys. I think it would be really a lot of fun. It would be great. So what I'm going to do is tomorrow I'm going to record, obviously pre-record, the Twilight Zone episode for Saturday, and then I am going to go ahead and premiere it for 10 a.m. Saturday. Okay, and what I will do, what happens is if you all have pushed the bell next to the subscribe button, if you're subscribed and you've pushed the bell next to the subscribe, it'll let you know and give you reminders, I think up to 30 minutes prior to the video premiering. Okay, so that we can all join in, and I think it allows us a few minutes prior the premiere of the video for us to go on there live and chat a little bit before the video actually starts. So if you would all like to join in this Saturday, 10 a.m. Alaska time, it would be a lot of fun to do that. And if it works out well, I'll try to do that on a weekly basis so that we can have a forum to chat live on a weekly basis. That would be great. All right, ladies and gentlemen, remember to be good to each other. When good people do good things happen. Remember to reach one, teach one, and repeat. If we all did this, the world would be a better place, and you know that it will be a better place. Many blessings to all of you and your families. Gold and silver is a good place to be right now. Alaska Prepper, this is Alaska Prepper, and I am out. God bless.